Welcome to the Payments Trilogue, where three seasoned professionals discuss payments and more for Europe and beyond.
Hello, my name is Michael Salmony, and I'd like to welcome you to the 50th episode of the Payments Trilogue, no less, where Javier, Ralph, and I have interesting people in and around payments. And today we're happy to have Charles, who's one of these clever people from the Netherlands who are always prominent in payments, but he's actually defected to the UK. And he will tell us about what new things are happening about payments in the UK. So over to you, Charles. Maybe you can tell us a little bit about yourself and what you're working on.
Thank you very much for the kind introduction, Michael. Great to be on the podcast. I'm a big fan. So yes, my name is Charles Damon. I'm Chief Product Officer at Token.io. Token is one of the leading A2A infrastructure providers in the UK. We enable pay by bank on behalf of for payment service providers, banks, and fintechs across the UK and Europe. But I represent the UK Payments Initiative as an industry director, and that's really what the topic is. About. We announced the UK Payments Initiative in the beginning of June at Money 2020. Yes, so delighted to be here.
Thank you, Charles. So can you give us a little bit of a background why there was a need to redo payments in the UK? I mean, some people could say that they've already got faster payments, which some people are still struggling with. Open banking is where the country where UK is doing best of all in the whole world. Why is there a need to do anything new in payments in the UK?
So yeah, it will be really good to take a little bit of a step back because open banking is present, but we took quite a different approach in the UK to the rest of Europe. Open banking came from the Competition Markets Authority, which required the incumbent banks, or which required to increase competitiveness between incumbent banks and neobanks. As a result, Open Banking Limited was set up. And in 2021, the Competition Markets Authority required the banks to set up so-called sweeping VRPs. VRPs are variable recurring payments, and sweeping VRPs are me-to-me transactions. And the purpose of that is to enable me-to-me transfers, in particular from an incumbent bank account to go, for example, to your neobank account. Variable recurring payments is the technology to make that really easy. Why? The reason is that it's consent-based. So a consumer or an account holder sets up a consent from their bank account to move money, either based on an instruction or based on a rule, so on a recurring basis, to move money from your incumbent bank account to a neobank account, for example. As a result, all the mainstream banks, so the CMA9, had to implement VRP as technology as part of the Competition Markets Authority order, so to say. So they had to implement the infrastructure. Sweeping VRPs now represent 18% of all the open banking transactions in the UK. Now, in 2022, some of the banks realized that there is actually a commercial opportunity to use this technology, which we call so-called non-sweeping VRPs or commercial VRPs. The leading bank in the UK was NatWest, and they announced a commercial model around VRPs. But they were a very innovative bank. They took a first mover step, but they were the only bank to do so. So that meant that as a TPP, we had agreements with NatWest. A number of other TPPs in the UK had an agreement with NatWest. We publicized it. We tried to sell it to merchants, but merchants, of course, want ubiquity. They want to make sure they can address all the account holders of all the banks in the market. And unfortunately, NatWest was the only bank that would, at that time, enable commercial VRP, have a commercial model around that, and a bilateral agreement. as a result, and if we look at it, the regulators started to look at this, and they saw that there was real potential with this technology. The FCA came out with the PSR at that time. FCA and PSR have merged now through an initiative called the Joint Regulatory, the JROC, the Joint Regulatory Oversight Committee, with a strategy recommendation that commercial VRPs should become a strategic priority. In 2024, this was in 2023, in 2024, the so-called National Payments Vision was announced. And this came from the Treasury, and the Treasury highlighted that, and it made a really big statement, that in the UK, account-to-account payment should become ubiquitous, both at point of sale and at e-commerce, and also pointed out that open banking technology should be used as the foundation of that. That spun off a whole set of work, and an entity had to be set up that was funded by the industry, so to say. So there were 31 companies funding this initiative to create the framework around this. So the technology was already there, but we had to build a commercial model. We had to start to look at what should we be doing around consumer protection, for example. So late last year, basically a number of the leading banks as well as the leading TPPs decided to become shareholders of and created so-called UK Payments Initiative to really make that a reality. So what happened? There are about 23 companies that have funded the UK Payments Initiative. And it's very different to what has happened before with kind of payment schemes, so to say, because this is a commercial for-profit entity. So the entities that have invested, the 9 largest banks in the UK, as well as 14 of the largest TPPs, are shareholders, have an equity stake in the company, as well as voting rights, which are equal. There's a board. The board has an MD, a chairman, a non-exec director, and then 4 industry directors, 2 from the TPPs and 2 from the ASPSPs. And I represent one of the TPPs, one of the TPP industry directors.
Could I jump in right here? Because from an open banking perspective, this is almost like a fairy tale, at least from, if I look at it from Europe's perspective. I wish and dream that we could have gone this way in Europe as well. And of course, we have tried. I guess we were even first with SPA and all of that, very, I think, similar.
Yeah.
But then the banks decided to, well, we love TPPs, we like them, but maybe not enough to actually work together. But instead, we do our own thing. We create the European Payments Initiative just amongst ourselves. We have similar activities in each country, Swish, Twist, Vips, Bithum, etc., where all the banks have decided to just club together, stay together, and do basically have a closed shop, a closed banking solution. So why is it that the UK has come to a different conclusion? Why did the banks not go this way in the UK?
Yeah, no, great question, Ralph. I think there's a combination of things. One, there was significant investment in open banking. The banks funded the open banking implementation entity, or what is now OBL. But also, pay by bank or open banking payments are a real success in the UK. It's still a small proportion of overall e-commerce payments, but it has become really a really visible payment method in the market. You can pay your taxes through pay by bank. You can buy goods and services on Amazon using pay by bank. You can repay your credit card or fund your account using pay by bank. So pay by bank already has become not necessarily mainstream, but is certainly becoming a really growing payment method. There are about 40 million payments a month now. So I think it's a combination of, one, there was a good framework. There's already that banks and TPPs are used to. The second element that I think was a critical piece was that the VRP technology was already in place with the banks. The banks had to build it as part of that sweeping VRP compliance mandate. So the investment actually for banks now to enable so-called non-sweeping transactions, it's the change of a flag, and then it's all around creating the multilateral framework or the multilateral rulebook, the commercial model, consumer protections, etc., etc.
Charles,
So
can
the
I just,
technology investment was relatively limited.
I mean, what you say is good, because I love Ralph's question. I think that's really to the point, and a lot of people are asking, why isn't this happening in Europe? I mean, in addition to what you said, there are two other reasons which are often cited. One is it was absolutely driven and governed in the right way. It was governed by the CMA, a competition authority, which really made sure that the banks got a new competitive offer. Whereas in Europe, the APIs were mandated, but whether they actually worked or not wasn't really followed up by a lot of NCAs. So it had a completely different governance. So that is one. Another one, this is a more controversial opinion, says is Brexit. Is the UK was actually able to set its own rules and didn't have to follow the PSD2 and PSR, which manifestly didn't work. What do you say to those two?
So certainly the Competition Markets Authority, or the CMA order, really helped open banking and ensure that open banking was implemented in a different way. There were, for example, user experience guidelines. There was app-to-app redirect from the start. The APIs were, and if we compare it with what we experience in Europe in certain markets, the framework was very good. And of course, again, the sweeping VRP implementation really helped. I think the second element in terms of Brexit, I'm not sure to what extent that made a big difference, and more from the perspective that it was prior to Brexit, the CMA order had already been established. So the UK already went its own route, and we adopted, of course, certain aspects of PSD2 when PSD2 came into effect. But I'm not sure to what extent that had a major effect.
Okay,
the interesting thing is,
it wasn't a Brexit benefit. I'm still trying to find one benefit that Brexit ever gave anyone. Maybe we find
that's a different conversation, Michael. That's I'm also looking for that one, but that's a different conversation.
But on the CMA thing, I mean, you've described some of the reasons. I mean, it really came home to me. I actually spoke to somebody from the CMA where I asked them that question. And I said, why are the banks opening up, which is not a natural thing to do? Lots of banks say, I want to keep the data to myself. I want to protect my old world. And how did you open it up? And the CMA said, well, we phone the CEO of the bank. If a TPP complains that the access is not working properly, the CEO, not some technical guy, don't send a fax 3 weeks later. They phone the CEO of the bank and says, if you don't get this working, we will reconsider your license and various other things. So that really puts pressure on people to change. And there's, of course, nothing like that happened in Europe. Could you confirm that? Is that your experience too? Because that seems a governance that is very powerful, right? And really ensures competition.
I mean, I know Ralph has alluded to it very often, and we see I don't know to what extent CEOs in Europe are contacted or not, but we could see certainly a lot more enforcement of the rules in the EU. We see a number of markets where it's a real challenge, even with providing a lot of evidence. We don't often see that active enforcement of the standards and the rules around PSD2. IBAN discrimination is also a very good example that still is ongoing, whereas we know that that is not a legal practice. So I think the other element, and this is we have been heavily involved with SPA as well, was that whereas EPI seemed to have been a CEO discussion, SPA unfortunately until now so far wasn't. We do see positive movements in certain markets where dynamic recurring payments is now being looked at also as a complement. You recently had I think people from Gyro API on the call. It's certainly being looked at in that context, and I don't think it should have to be one or the other. If we open up, and particularly with PSD3 now, and the work also to establish recurring payment mechanisms for some of the more bank-led initiatives, why wouldn't you leverage that through an API and monetize that at the same time? And a really interesting aspect is that coming together as shareholders in UK Payments Initiative has really changed the mindset between banks and TPPs. You suddenly have aligned incentives. So it actually has become a lot more collaborative instead of the antagonistic approach that we have experienced sometimes in the past.
There's my next question, actually. Sorry to jump in again. But the governance. So you already mentioned Gyro API. And of course, a big difference between that and SPA is that Gyro API is the child, the baby of the German banks. And the TPPs are invited to the party, but not with not too much to say so far. So SPA is 50-50.
Yeah.
The UK PI is what? And how do you break the tie if needed?
It is 50-50. So 2 industry directors from TPPs, 2 industry directors from ASPSPs, independent chairman, or there's a chairman that's employed by UKPI, an MD, and then an independent non-exec director. There's certain elements that are, for example, where industry directors don't get involved, in particular price setting. So there's an independent pricing committee, and then when it comes ultimately to a vote, and that's where the independent, so the chairman, the MD, and the independent net are the decision makers at that time. So both ASPSPs and TPPs got involved with the appointments of the MD, the non-exec, the independent non-exec director, and the chairman.
Well, if I may, because I think this part, this collaboration and trust, is probably what we are missing. Many times we always say that financial services are based on trust, but then we forget about it and we think, or we talk about infrastructure, investment, and all that. But at the end of the day, it's trust and it's confidence in between the different partners. And after Michael's train of thoughts, I was wondering, what's the relevance of national communities? Because what I see is that at the national, and you know well the UK market, before and after the Brexit, and you know well also the European Union market. So what's the relevance of national communities? What I see is at a purely national community, it is easier to get to certain degrees, certain levels of trust that can allow certain initiatives or certain alignments. Well, still at European Union level, we have this 2 tiers system in which we have still national communities, but then we are trying to build a European community. I would say still we are not yet. Barely we are in the childhood of this financial community at European level, which brings a lot of complexities, because while I see that a British TPP can talk and can share many things with a British bank, it is much more difficult for a German TPP to share those whatever circumstances with a Portuguese bank. So and we still at European level, we have not fully created this banking community, not to talk about the wider financial community, including the TPPs. So are national communities still that relevant? Do we have still to focus on national communities to create, to bring in an initial trust on which to build? or do we have to aim to a European level trust, which still I don't see it very materially? What can we do when we have, at least in Europe, these two tiers system in which we have to play at two levels, and many times we don't get anywhere because we are just fighting those two battles in different fronts.
Yeah, it's a really interesting question. I think on the one hand we have an opportunity with PSD3 to almost bring Europe together in a way in which we will have, and I often say this, it's kind of, we often talk about payment sovereignty in Europe, but actually pay by bank in Europe reaches anyone in Europe. So do we really need another payment method to do that? And so PSD3 will hopefully help us to harmonize this further and to address the user experience issues. Of course, where we also have really evolved is now with the SEPA instant regulation, that suddenly we have a better set of rails. We now, with PSD3, will have hopefully a better set of APIs and a more harmonized user experience. Can we, with standardization such as through the Berlin Group, where the SPA APIs are also part of that, create this model where, one, it becomes interesting for banks to have, whilst we're opening the bonnet, so to say, to make the implementation of something like dynamic recurring payments available across the different banks in the different markets using that single API, and leverage some of the great work that was already done by SPA, because the model is there to just use. So I think there's an opportunity there. I guess the flip side is that not the interest in different markets may not always be aligned, and that's, I think, that the challenge, so to say. I mean, regulators have still played an important role in the UK to make this happen. There was a lot of industry work, and industry invested a lot of time and money, and organizations such as UK Finance, for example, really contributed to creating contracts that could be used by TPPs and banks to establish initial bilateral agreements, or the commercial model for e-commerce transactions, which is also where they got involved. So it has been a whole collaboration of industry and regulators, but regulators still played an important role in the UK as well.
And could I ask, well, we already mentioned competition authority. There's also the other aspect of, well, if I understand correctly, they said that there will not be a Competition Act investigation at this stage. So you're having some time now, I guess, to agree. And I don't know if you have already, or how much you can talk about it. We had similar situation in SPA. It took a year or so to come to a conclusion, which then both sides didn't like, and is also one of the obstacles there. And I guess there's a different process in Germany, which are API, but also with a lot of involvement by the competition authority there. So where are you with that?
So as always, Ralph, you're very well informed. There is indeed one of the critical pieces in the creation of UK Payments Initiative was some of the legislative work that is ongoing, the so-called Data Use and Access Act. That will soon go out for consultation. That gives the FCA a set of powers, so the Financial Conduct Authority, a set of powers to overcome pricing issues around and the competition issues around pricing. There will be a mandation element for banks then to effectively adopt this scheme, so to say. So there's a very clear legislative act ongoing to overcome the competition issues, which will enable us to really launch the e-commerce use cases next year.
And is there already a discussion around whether there should be ad valorem percentage fees as well, or just fixed fees? Because that has been one of the biggest discussions over here.
Yes, so there is currently a pricing model. So perhaps important to say, a UK Payments Initiative went live on the 1st of June. 5 out of 6 major banks are transacting, and 5 of the major TVPs are transacting. Currently, the model, so currently it's a fixed fee model because it addresses 5 use case categories. Regulated financial services, so you can top up your e-money account, you can pay for regulated utilities, so you can pay, so it's more like a direct debit substitute, so for your phone bill, your electricity, your water bill, your gas bill, etc. You can pay for regulated, it's from to purchase rail tickets from regulated rail companies, because there's an alternative form of consumer protection, the so-called delay repay scheme. Payments to local governments and payments to charities. So the reason why those 5 categories are currently permitted is because there's no, because those are all regulated and you don't require purchase protection like through, for example, something like chargebacks. So to answer your question on ad valorem, that is currently being looked at. Particularly for e-commerce purchases. So you come then into the whole risk balance, who will, in case of disputes, who will be covering those, where does the liability sit? The work that was initially done by UK Finance looked at and recommended an ad valorem model. The advantage of an ad valorem model is that it also really increases the scope, because of course you can then suddenly start to also use this new scheme for your very low value recurring transactions, your streaming music or TV subscriptions, for example, or your EV charging, or your ride hailing services, or things like that. So yes, long-winded answer to say yes, ad valorem is certainly being looked at the moment.
Yeah, because I mean, from a merchant's perspective, I think the expectation, I guess it's not different in the UK, at least certainly over here, is that pay by bank is cheaper and will be as safe or even safer than cards. So essentially, you get more protection for the merchant side. You need less protection on the consumer side because of more security, SEA, etc. And the whole thing is then hopefully just transaction based, i.e., fixed fees, etc. So there is this big expectation, which hopefully will translate sooner or later into the demand pull on the merchant side and getting more of this and maybe less of cards and other traditionally a bit more expensive solutions. And what do you expect in the UK? I guess you have big ambitions there. So, and well, not just replicating all the cards and their bells and whistles is probably, well, not what you want.
No, indeed. So yeah, in order to drive adoption, it is critical that commercial VRP has a lower cost of processing for merchants. Commercial VRP overall drives a lot of advantages for merchants. One is a better user experience. Once you have set up your consent, your one-off consent through which you apply SEA, your subsequent transactions, either customer initiated, are one click without SEA, or they're merchant, or they can be merchant initiated for fixed or variable amounts. So when I was processing at a merchant, I was always looking at 3 things. You have better user experience, better acceptance, so the acceptance we get through coverage, and a lower cost of processing. So that certainly there's a big expectation that there will be a lower cost of processing. On the consumer protection element, it's an interesting element because it's a little bit different. The UK is a little bit different to some other European markets like Germany or France, for example, where you have carte bancaire, or Germany, in that consumers are used, debit cards are the most popular payment method. Consumers are used to being protected through chargebacks and can raise chargebacks. Now, should we replicate what is currently in the market? Chargebacks are 50 years old, are very expensive for both banks as well as acquirers as well as merchants to process, and they don't give a great user experience. We believe that there are opportunities to do a number of things. One, could the merchant play a bigger role in providing good refund mechanisms, etc., etc.? Can we therefore avoid a number of the calls that are being made to banks to raise a chargeback? Have you spoken with the merchant before? The bank should not be the first port of call when you have a dispute with a merchant. It should be the merchant that has the first port of call. But I think the second element, I think that you can make some real improvements to take costs out of the system. An example I often use is MasterCard did a study and highlighted that 30% of chargebacks that are raised with the issuer come from people that do not recognize the transaction because they can't recognize the good or service that they bought, or they can't recognize the name of the merchant because it was the legal entity instead of the merchant name. 30% of chargebacks. So by having longer descriptors, which is supported in the open banking standards, where you can have much longer descriptors that you can see within your mobile banking app or your bank statement, you can avoid up to 30% of those chargebacks because consumer can just see what they have bought, and therefore they don't have to call their bank. So we believe that there are a number of improvements that we can make and really take also disputes into the digital age, so to say, and make it much more adapted to this new payment method.
Charles, typically the UK market works as a leading indicator to the rest of Europe, in many cases at least. So what do you expect, or what are you aiming to in 5-10 years, so that we can expect we can learn what will happen in the continent in 10 to 15 years?
Wow, that's if I had a glass ball. I hope, I don't believe that, so I truly hope that in 10 to 15 years, we will have, that every person in Europe will be able to leverage the open banking rails to make a payment, but also to make sure that there is something in it for all parties in the system. So there should be an incentive for banks to invest more to provide a better user experience. I think PSD3 provides a really good driver for banks, at least, to, as Gijs would say, open up the bonnet, so to say, to build better APIs, to build a better user experience. And let's leverage this to build some of those premium services that we identified in SPA. And I think, given the interest that we have seen from major merchants, dynamic recurring payments is really a feature that a lot of, given the flexibility that it provides, the use cases that it can cover, a real opportunity for pay by bank, or whatever we may call it in future, to make a real impact and have multiple ways to address the sovereignty question in Europe. We believe that there are multiple ways to skin the cat, so to say.
Yeah, I have one more question on the. Well, actually, going back, you alluded to it already, because, well, you know, one of the objectives we have with this podcast here is to show that we'll actually need less regulation rather than more, that there is more common ground between the stakeholders, and in particular also between fintechs and banks, which are too often seen just really on opposite sides of the table. And so driving collaboration, driving a dialogue or a trialogue, this is what we're trying to achieve here. And that seems as if you've now achieved in the UK with this UK Payments Initiative. But let me just put my finger into that one thing on whether you believe it would have happened without a regulatory push. So without the Damocles sword there over the banks, that something worse may happen unless they now start to play ball.
I think it would have been difficult. The national payments vision really was a shot in the arm, so to say, so a really positive development, because it really demonstrated that the government really wanted to make account-to-account payments ubiquitous. It was a very strong statement. The regulatory intervention definitely helped. There was a strong push. So it made it more front and center, and that came back to a little bit to your point, Michael. It came on a higher level. CEOs were involved in that conversation. Say, well, no, actually, this is a really important element that we need to support throughout the organization.
But what I really like is also that it wasn't only sort of mandated and enforced, and sort of there was also trying to see common ground and how to align the incentives of the fintech and the banks. And there's a lot of, and I think that's always the more successful model, right? I mean, mandating and forcing that. Sort of, we've seen plenty of examples where that doesn't work too well, right? It's so much better if everybody sees their own advantage, and I get the impression you've really done that.
Yes, and this is why I think the setup of having a company limited by shares, where effectively there's because the funding was actually not is proportionate in that banks fund more but get more equity, but with equal voting rights. So, and that really helped to have both still an equilibrium between TPPs and fintechs, whilst the investment structure could also give the returns should, if and when they will be there in after the initial investment. And the way the funding was structured is for a period of 6 years. So this means that the scheme could run based on the volume projections for about 6 years without incremental funding. So that was also an important piece because, as we know, with every new scheme, there's a build-up. There is a period that we need to implement, that we need to get PSPs on board, merchants on board, drive volumes, etc.
Right, then
I have one before you call the. I see Michael already suggesting that we run out of time, but I have one more question. And sorry, it is, of course. So I already said, looking at you and what happens there with Envy from a European perspective, and of course we hope that it'll sort of give some. Traction here in a similar direction in Europe, but I'm also a little bit concerned about that, in Europe. So we have these, there's only the bank solutions, the closed banking solutions, which are seen to be the savior of European sovereignty, and they are now joining somehow. You have these roaming agreements between the different solutions, different countries. Could you be tempted to join them as the UK leg in the closed banking network there?
Well, that's not my decision. Let me flip it around. I think if we take the lens from a merchant, for a merchant, it's actually really difficult to, and of course there are parties that can help, but to integrate to all these different solutions. This is where I think open banking and pay by bank has so much more of an advantage because through a single API, you reach all the EU member states, all the account holders. That is payment sovereignty. So with instant payments now being universal, with PSD3 addressing the user experience, I think there's a major opportunity for pay by bank to emerge as that real alternative. So I'd like to focus more on making that, enabling that, and And then we'll see if there is a need for UK Payments Initiative to join any of the domestic schemes. But that's certainly not a
love
decision.
your answer, and I love that highlighting again that it's the really open banking or paper bank is the only one to reach everyone in Europe and in the UK. Anyway, sorry. Yeah.
No, I think, but unless anybody else has any urgent topics they want to address, I would gradually say, time, gentlemen, please, as it used to be said at the pubs before they closed. But I've been super impressed. I mean, this is, we'll definitely be following this, what happens in the next 6 years. So on the 500th episode of the TPT, we will ask you back to see where things have ended up. I personally was particularly impressed at the breadth of this topic, because I'd initially always been a bit concerned. It's also focused on VRP. It's the only one model that the UK is looking at, whereas Berlin Group has 100 different APIs and scenarios and use cases. And that has changed. When I hear you now, you're looking at card on file replacement, direct debit replacement, B2B, paying taxes, charging your EV, paying at Amazon. This is becoming a really broad instrument, right? It's not. All power to you, Charles. We all wish you well. I think it's for the benefit of the banks, the fintechs, the consumers, the government, sovereignty, everybody. So really wish you well. So thanks very much, Charles, Javier, and Ralph, and everybody listening. I hope you enjoyed it, and look forward to seeing you next time.
Thank you very much.
Thank you.
Thank you. Bye-bye.
Many thanks for watching and listening. We hope you enjoyed this episode. Looking forward to seeing you again next time.